Imagine walking into a dollar store with $20 in your pocket. You can walk out with a bag full of snacks, cleaning supplies, batteries, toys, household products, and random things you never planned to buy. And somehow, the store can still make billions of dollars in sales. That creates a strange business question. If everything is supposed to be cheap, where does the profit come from? Because a store selling a $1, $3, or $5 product doesn't have much room to make money on each individual item. There is no luxury markup, no expensive membership, no five-star restaurant experience, no premium brand, just cheap stuff. And yet, companies built around this model have become enormous. Dollar General generated about $42.7 billion in fiscal 2025 sales, while Dollar Tree's continuing Dollar Tree business generated about $19.4 billion. Dollar General. So today, we're going to follow the money. Not the shopping carts, not the colorful signs, the money. Because the secret to the dollar store business isn't simply buying something cheaply and selling it for slightly more. It's about controlling almost every part of the economic equation. And once you see how that equation works, the business looks very different. Let's start with the most obvious question. How can a store sell something for a few dollars and still have anything left over? The first answer is volume. A dollar store doesn't need to make a huge amount of money on one item. It needs millions of transactions. Think about a hypothetical product that sells for $2. Suppose the retailer's merchandise cost is $1.20. That leaves 80 cents before the other expenses of running the store. That 80 cents has to help pay for employees, rent, electricity, transportation, distribution centers, technology, theft, damaged inventory, corporate overhead, and everything else. So the individual product isn't generating a fortune. But multiply that transaction by millions of customers and thousands of stores, and the economics begin to change. This is the first principle of discount retail. Tiny margins can become enormous dollars when the volume is enormous. But volume alone isn't enough. A supermarket can sell enormous amounts of merchandise and still struggle to make attractive profits. The real trick is controlling the cost structure. And that's where dollar stores become interesting. Imagine two retailers selling the exact same $2 product. Retailer A has a huge store with expensive fixtures, wide aisles, dozens of employees, a large parking lot, sophisticated displays, and thousands of different products. Retailer B operates a smaller location, carries a narrower assortment, uses less expensive fixtures, requires fewer employees, and focuses on products people buy frequently. Both sell the product for $2. But their economics aren't the same. The second retailer can potentially operate with a much lower cost base. And that is the fundamental idea behind the dollar store format. The customer sees the price. The company sees the entire cost structure underneath that price. This is where most people misunderstand the business. They think the secret is simply buy cheap, sell cheap. It's actually closer to buy efficiently, transport efficiently, stock efficiently, operate cheaply, sell frequently, repeat thousands of times. Now let's follow that money from the beginning. Before a product reaches the shelf, somebody has to buy it. Large discount retailers have enormous purchasing power because they're buying at massive scale. If you're a small independent store ordering 500 units of a product, your negotiating position is limited. If you're a national retailer ordering millions of units, the conversation changes. Suppliers want access to that volume, and that creates an opportunity for the retailer to negotiate pricing, packaging, product specifications, promotions, and delivery terms. Sometimes the retailer can also sell products under private labels or source merchandise specifically designed for the discount channel. The goal isn't necessarily to find the cheapest product in America. The goal is to find a product that delivers the right combination of cost, quality, size, packaging, and expected demand. And this creates another important advantage. Dollar stores don't need every product to be a superstar. They need the entire assortment to work. A customer might enter for laundry detergent, then buy snacks, then batteries, then a birthday card, then a seasonal decoration, then a drink. The individual purchase may be tiny, but the basket becomes much larger than the price of the original item. And this is one reason average transaction value matters so much. Dollar Tree's fiscal 2025 comparable store sales increased 5.3%, with average ticket up 4.3% and customer traffic up 1.0%. Dollar Tree Inc. That tells us something important. The business isn't simply about getting more people through the door. Getting existing customers to spend a little more can be just as powerful. And there's a fascinating psychological component here. When prices are low, customers often feel that adding one more item isn't a big decision. A $1.25 item feels different from a $25 item. A $3 item feels different from a $30 item. The friction is lower, and that can encourage impulse purchases. So the store isn't only selling products, it's selling convenience and low perceived risk. But here's where the economics get even more interesting. The old image of a dollar store was literally a store where everything cost $1. That model sounds simple, but it creates a serious problem. What happens when the cost of merchandise, transportation, labor, and other expenses rise? You can't keep selling everything for exactly $1 forever. At some point, the math stops working. That's one reason modern dollar store economics moved beyond the literal dollar. Dollar Tree, for example, shifted toward a multi-price model, allowing products at prices such as $1.25, $3, $5 and higher. The company says increased multi-price penetration contributed to its fiscal 2025 average ticket growth. Dollar Tree, Inc. And that seemingly small change is actually a major business model evolution. Because now the retailer has another lever. It doesn't have to squeeze every penny out of the supplier. It can also change the selling price. Suppose a product costs the retailer $1. Selling it for $1.25 produces 25 cents of gross profit before operating expenses. But suppose the company finds a product that costs $2.50 and can sell it for $5. Now, there is $2.50 of gross profit before operating expenses. The customer may still perceive it as a bargain. That's the beauty of value retail. The retailer doesn't necessarily need the absolute lowest price. It needs the customer to believe the price is low relative to the value they're receiving. That distinction is enormously important. Because the customer walks into the store thinking about price, the company is thinking about margin. Now let's look at what happens after the product is purchased. This is where a lot of the money disappears. The first major cost is the merchandise itself. Then there's transportation. The product might travel from a manufacturer to a distribution center and then to a store. Every mile costs money. Every handling step costs money. Every warehouse costs money. Every employee involved in the process costs money. Then the store itself has expenses. Rent, utilities, store labor, maintenance, insurance, technology, security, loss prevention, and something retailers hate perhaps more than almost anything else: shrink. Shrink includes inventory that disappears through theft, damage, administrative errors, and other discrepancies. It sounds small, but at the scale of billions of dollars in merchandise, even a small percentage can become hundreds of millions of dollars. And this is why improving something that sounds boring can be extremely profitable. Dollar General said its fiscal 2025 gross margin improved partly because of lower shrink, higher inventory markups, and lower inventory damages. Dollar General. Think about what that means. The company didn't necessarily need customers to suddenly spend dramatically more. Reducing merchandise losses improved the economics of the existing sales base. That's a powerful retail lesson. Sometimes the easiest way to make more money isn't selling more, it's losing less. Now let's put some numbers around the business. Dollar General generated approximately $42.7 billion in fiscal 2025 sales. Its gross profit margin was about 30.7%. Dollar General, that means that very roughly, for every $100 in sales, around $30.70 remained after the cost of merchandise, before the rest of the company's operating expenses. That sounds pretty good. But now watch what happens. That $30.70 still has to pay for stores, employees, distribution, corporate operations, depreciation, and other costs. This is why revenue is such a dangerous number to look at by itself. $42.7 billion sounds enormous, but the business doesn't get to keep $42.7 billion. Most of it flows right back out. And that's the difference between revenue and profit. Dollar Tree's continuing business gives us another useful example. In fiscal 2025, the Dollar Tree segment generated about $19.4 billion in sales and $7.05 billion in gross profit. a gross margin of about 36.4%. Dollar Tree Inc. But after selling general and administrative expenses and other costs, operating income was about $1.65 billion. Dollar Tree Inc. So imagine the money flow. $100 comes through the register. Roughly $36 goes toward gross profit after merchandise costs. But that $36 is not the owner's pocket money. A large portion then gets consumed by operating expenses. What remains is much smaller. That's the real retail game, and it explains why efficiency matters so much. If a retailer can improve its gross margin by even 1 percentage point across tens of billions of dollars in sales, that's potentially hundreds of millions of dollars of additional gross profit. 1 percentage point sounds tiny. At national scale, it isn't. This is where the dollar store model becomes almost like an industrial machine. The company is constantly trying to make tiny improvements. A slightly better purchase price, a slightly better product mix, a slightly lower freight cost, a slightly higher average basket, a slightly lower shrink rate, a slightly better store layout, a slightly more efficient distribution system. Each improvement may look insignificant, but multiply it across thousands of stores and billions in sales. Suddenly, tiny percentages become enormous amounts of money. And there's another reason these stores can survive with relatively low prices. They don't need every category to have exactly the same economics. Some products can be traffic drivers. Others can have better margins. Some are purchased because they're necessities. Others are impulse purchases. A customer might come in because they need milk or detergent, but while they're there, they see a seasonal product with a much better margin. That's why the assortment matters. The shelf isn't just a collection of products. It's a portfolio. Some products attract the customer. Some generate margin. Some increase basket size. Some exist because customers expect to find them. And some are there because they become highly profitable during specific seasons. Think about Halloween, Christmas, back to school, summer, Valentine's Day. Seasonal merchandise can create bursts of demand, but it also creates risk. If the company buys too much, it has a problem. A Halloween product doesn't become more valuable after Halloween, it becomes harder to sell. That means inventory management is critical. A product sitting on a shelf isn't necessarily an asset. If nobody wants it, it's a liability. The retailer already paid for it. The shelf space is occupied. And eventually the product may have to be discounted. Dollar Tree's 2025 filing specifically noted markdown pressure and a $56 million write-off related to slow-turning SKUs as part of its shelf productivity efforts. Dollar Tree Inc. That is the hidden side of cheap retail. Cheap prices don't eliminate mistakes. They make operational mistakes more dangerous because margins aren't enormous. Now let's talk about the store itself. Why not build massive stores? Because bigger stores cost more money. More square footage means more rent or property costs. More space means more utilities. More space often means more merchandise. More merchandise means more working capital. And more products can mean more labor and more complexity. The ideal dollar store is not necessarily the biggest store. It's the store that produces enough sales from a relatively efficient footprint. That creates a critical metric: sales productivity. How much revenue can you generate from the physical space? If one store produces $2 million in annual sales and another produces $1 million while costing almost as much to operate, the first location has much stronger economics. And this is why location matters so much. A discount retailer can be especially valuable in communities where consumers want low prices and don't necessarily want to drive 20 or 30 minutes to a giant shopping center. Convenience becomes part of the product. The customer isn't only paying for the merchandise, they're paying with their time, and the retailer is monetizing that convenience. Now let's talk about one of the most controversial parts of the model: how cheap can the merchandise actually get? Retailers constantly negotiate with suppliers. They can change package sizes. They can alter specifications. They can source from different countries. They can adjust the product mix. They can introduce higher-priced items. And they can use pricing strategically. This matters especially when import costs rise. In 2025 and 2026, tariffs became another major variable for retailers. Federal Reserve research found that tariff-related price pressure developed gradually through 2025, with particularly strong increases for goods imported from China. Cuck do truly and bang. For a discount retailer, that creates a difficult problem. If the retailer's product cost rises but the selling price stays fixed, the margin gets squeezed. For example, suppose an item sells for $5 and costs $3. That's a $2 gross profit. If the cost rises to $3.50, the gross profit falls to $1.50. The customer still sees a $5 price, but the retailer has lost 25% of the gross profit dollars on that product. That is why flexible pricing becomes so important, and it also explains why the modern dollar store model is less about everything costs $1 and more about everything feels like a bargain. That is a much more sustainable concept, because the retailer can adapt, and this brings us to the biggest misconception. People think dollar stores make money because everything is incredibly cheap. Not exactly. They make money because the entire system is designed around low-cost operations and high transaction volume. The price is only one piece of the puzzle. Imagine two businesses. Business A sells expensive products with a 50% gross margin but has huge overhead. Business B sells cheap products with a 30% gross margin but operates thousands of locations, turns inventory quickly, and keeps expenses tightly controlled. Which one is more profitable? You can't answer without looking at the entire income statement. That's the point. Price doesn't determine profitability. Economics do. Now imagine a hypothetical dollar store location. Suppose it generates $2 million in annual sales. And suppose, purely as an illustration, its gross margin is 30%. That's $600,000 of gross profit. But now imagine the store needs $250,000 for payroll and store labor, $150,000 for occupancy, $50,000 for utilities, maintenance, taxes, insurance, and other store costs, and another $50,000 allocated to various operating expenses. That leaves approximately $100,000 before certain additional corporate, financing, depreciation, and tax effects. The exact numbers will vary dramatically by location and retailer. But the point is simple. A store can look busy all day long and still have surprisingly little profit left at the bottom. This is why break-even matters. If a hypothetical store has $500,000 of annual fixed operating costs and earns $2 of contribution margin per transaction, it would need roughly 250,000 transactions to cover those fixed costs. That's about 685 transactions per day. Again, that's an illustration, not a claim about a specific retailer, but it shows the basic machine. Thousands of transactions, every day, all year. And if the store gets above break-even, those additional sales can become increasingly valuable because many fixed costs don't rise proportionally with every additional transaction. That's operating leverage. The store is already open. The rent is already being paid. The lights are already on, so another customer buying a few items can contribute meaningful incremental profit after the variable costs associated with that sale. But leverage works both ways. If sales fall significantly, those fixed costs don't disappear. The rent doesn't care. The refrigeration system doesn't care. The building insurance doesn't care, and employees still need to be paid. This is why a discount retailer can be extremely resilient in some economic environments, but still vulnerable to operational problems. During economic stress, consumers may trade down. That can help discount stores. Dollar Tree reported that its fiscal 2025 comparable store sales increased 5.3%, helped by higher average tickets and traffic. Dollar Tree Inc. But inflation can also hurt. If wages rise, if freight rises, if tariffs rise, if shrink rises, if rent rises, if merchandise costs rise, the company has to find a way to protect the margin, and sometimes that means raising prices. Sometimes it means changing products. Sometimes it means negotiating harder with suppliers. Sometimes it means closing stores. And sometimes it means accepting lower margins temporarily. This is why the business isn't simply about selling cheap products. It's a constant balancing act. Price versus margin. Traffic versus basket size. Inventory variety versus inventory efficiency. Store growth versus store profitability. Convenience versus operating cost. And perhaps the most important balance of all, growth versus control. Opening another store can increase revenue, but opening a bad store can destroy capital. The company has to spend money on construction, inventory, equipment, employees, and working capital before the store produces enough cash to justify the investment. And that brings us to financing. Large retailers generally don't fund every expansion project with cash sitting in a bank account. They use a combination of operating cash flow, capital expenditure budgets, debt, leases, and other financing mechanisms. Dollar Tree reported about $1.1 billion in capital expenditures for its Dollar Tree segment in fiscal 2025. Dollar Tree, Inc. That's a useful reminder. Even a cheap retail business can require enormous amounts of capital. Because cheap products don't mean cheap infrastructure. You still need distribution centers, technology, warehouses, stores, refrigeration, vehicles and logistics, security, employees, inventory, and thousands of physical locations. The business may sell inexpensive merchandise, but operating a national retail network is expensive, and that's where the real competitive advantage appears. A company that has already built the network has something a new competitor can't easily copy. It has purchasing scale, distribution infrastructure, supplier relationships, brand recognition, real estate, customer habits, data, technology, and thousands of locations. A startup could open one cheap store, but competing with a national discount chain means competing with an entire machine. And that is the big reveal. The dollar store business isn't really a business about dollars. It's a business about scale economics. The individual product doesn't have to be spectacularly profitable. The store doesn't have to look luxurious. The transaction doesn't have to be large. The business wins by doing ordinary things at extraordinary scale. Buy millions of products, move them efficiently, put them near customers, keep operating expenses under control. Get customers to buy several things instead of one. Reduce inventory losses, improve margins by tiny amounts, and repeat the process thousands of times. That's why a 1-cent improvement can matter. Imagine a retailer selling $20 billion worth of merchandise. If it can improve its economics by just 1% across that sales base, that's $200 million in additional gross profit, not from inventing a revolutionary product, not from doubling prices, just from improving the machine. And this is why retail executives spend so much time obsessing over numbers that customers never see. Freight rates, shrink. Inventory turns, average ticket, labor hours, store productivity, markdowns, supplier costs, gross margin. Every one of those boring numbers eventually reaches the bottom line. And there's another fascinating development happening right now. The traditional dollar store customer isn't necessarily the only customer. When consumers across income levels become more price conscious, discount retailers can attract people who previously shopped elsewhere. That expands the market. The value proposition becomes, why pay more if I can get something good enough for less? And once a retailer convinces customers of that, it doesn't need to win every shopping trip. It just needs to become part of the routine. That's powerful. Because routine creates repeat purchases, and repeat purchases create predictable revenue. And predictable revenue makes the entire business easier to operate and finance. But there is a dark side. The same low price promise that attracts customers can make the business incredibly sensitive to cost inflation. If the company can't raise prices quickly enough, margins compress. If it raises prices too aggressively, customers may leave. If it cuts product quality too far, customers lose trust. If it expands too quickly, stores can become inefficient. If it carries too much inventory, markdowns rise. If shrink gets out of control, profits disappear. And if debt becomes too expensive, cash flow gets squeezed. So is the dollar store business actually a good business? The answer is, it can be. But it is not easy money. The strongest operators have several advantages working together. They buy at scale, they understand their customers, they control store-level costs, they manage inventory carefully, they keep the assortment productive, they use pricing strategically, they have efficient distribution, and they operate enough stores to spread corporate infrastructure across a massive revenue base. A weak operator can copy the price. It can't easily copy the economics. And that may be the most important lesson of the entire story. Cheap prices do not automatically create a cheap business. In fact, selling cheap products can require an incredibly sophisticated operation. Because when your selling price is low, you don't have much room for mistakes. A $10 mistake is annoying in a $100 transaction. In a $2 transaction, the economics can be completely different, so the business survives by making thousands of tiny decisions correctly. A few cents here, a few percentage points there, a little less waste, a little more volume, a slightly better supplier agreement, a slightly higher average basket, a slightly lower shrink rate. Individually, none of these looks impressive. Together, they can create billions of dollars in revenue and hundreds of millions or billions in profit. And that's why the dollar store is one of the best examples of a simple-looking business hiding a complicated financial machine underneath. The customer sees a $1.25 item. The company sees procurement, transportation, inventory, store labor, rent, shrink, gross margin, working capital, volume, operating leverage, and eventually profit. That's the difference between looking at a business and understanding a business, because the real business isn't what's sitting on the shelf. The real business is everything happening behind the shelf. And once you start following the money, you realize something surprising. Dollar stores don't make money because everything is cheap. They make money because everything around the cheap price is engineered to be efficient. If you enjoyed this breakdown, subscribe to Money Behind for more stories about the businesses hiding in plain sight. And tell me in the comments, would you actually want to own a dollar store, knowing how thin and operationally demanding the economics can be? Because the next time you walk into one, don't just look at the price tag, look at the machine behind it. That's where the real money is.